Hi, I'm Gina Markin, owner of Sound Benefit Administration. This short video is to explain how you can offer employees a high-deductible HSA qualified medical plan and an HRA while still keeping your employees eligible to contribute to their health savings bank accounts. I call this a super combo offering. This is going to blow your mind. Here's how the super combo works using employee-only coverage. An employer offers a $3,000 individual high-deductible HSA qualified medical plan. The employee only needs to meet the minimum required deductible amount set by the government. It's $1,400 for single coverage in 2020. Every October, the government announces what the minimum limit will be the following year based on cost of living changes. You can search the internet by typing HDHP minimum HSA deductible for the current year or future year if you're searching after October. The employer promises to pay 100% above that minimum deductible limit if the employee provides an explanation of benefits form showing he's gone over $1,400 in this case, which would be up to $1,600. Remember, $1,400 and $1,600 equal the $3,000 deductible. Since the employee is required to meet the $1,400 minimum deductible limit according to the government, it entitles him to open up an HSA bank account. He can fund that account up to the annual limit allowable by the IRS, which is $3,550 in 2020. If he's over age 55, he can contribute another $1,000. Here's one example of what this might look like. The employee is responsible for only $1,400. He decides to contribute $1,400 to his HSA bank account, saving him 25% in federal, Social Security, and Medicare taxes by having pre-tax payroll contributions. Note that each employee's tax savings is different according to his federal tax bracket. Now subtract $350 in tax savings from $1,400 and his deductible is now only $1,050. That's a low deductible by today's standard. If that wasn't good enough, both the employee and the employer save money on taxes. The employer doesn't have to pay that 7.65% FICA match. $1,400 times 7.65% equals $107.10 in employer tax savings. That's a win-win situation. Wait, it gets better. The same scenario, except the employee is going to put the full $3,550 in his HSA bank account, resulting in $887.50 in tax savings. Subtract that from his $1,400 deductible responsibility, and now his deductible is only $512.50. That's a really low deductible. The employer enjoys $271.58 in FICA savings in this situation. Now you may be asking yourself, why wouldn't the employer just put money into the employee's HSA account and be done with it? I'd like to answer that question for you. In this example, employer A has 10 employees and has a budget of $4,000 to contribute to employee HSA accounts. Employer A implements a $3,000 HSA high deductible qualified medical plan. Again, we're illustrating employee-only single coverage, not family coverage. Employee A contributes $400 to each employee's HSA bank account to meet his budget. That's $400 in 10 accounts for a total of $4,000. From the employee's point of view, his deductible responsibility is $3,000 minus the $400 employer contribution, making him responsible for $2,600. It's not as attractive to the employee as the super combo strategy and no tax savings to the employer. When the employee terminates employment, they walk off with those employer dollars, never looking back, and go to look for work at an employer with a lower deductible plan. Let's look at this again from another angle, comparing it with the last slide. We have employer A with 10 employees and a super combo scenario. Employer A implements a $3,000 high deductible health plan. Employer A will reimburse $1,600 through an HRA when the employee goes over the minimum required deductible of $1,400. The maximum risk to the employer is $1,600 times 10 employees for a total of $16,000. Not all employees will go over the $1,400 threshold. Let's say only 25% of them do. If 16,000 is 100% risk, then 25% is a $4,000 risk. Wasn't that employer A's budget? He's paying the same amount to employees in both scenarios, but from the employee's perspective, his deductible responsibility is $1,400, not $2,600 in the last slide if the employer only contributes $400 to each employee's HSA account. Okay, it gets better. Now let's supersize this with a health flexible spending account. Employer A also offers a limited health FSA plan. It can only reimburse dental, vision, and non-deductible medical expenses. It can't reimburse medical deductible expenses, or it would make employees ineligible for a health savings bank account. Let's say one of the employees decides to get orthodontia work. The down payment for braces is $1,000, and monthly contractual payments add up to another $1,000 in the first year. The benefit to the employee to run dental costs through a limited purpose health FSA is that his entire annual election is available to him on day one of the plan year. He can make that $1,000 down payment from his FSA funds, even though he may not have contributed anything to it yet. The HSA account can reimburse the very same dental expense, but he's limited to the balance in his account while the FSA offers him his entire election on day one. Additionally, he can keep on growing his HSA balance and not reduce it every month by the amount of this dental work by running it through a limited purpose health FSA instead. Another employee has a child in daycare. Through the FSA, he can pre-tax childcare expenses up to $5,000, saving approximately 25% in taxes. The employer also saves 7.65% in FICA savings. The third account in a flexible spending account is the premium account. Employees with payroll deductions for insurance premiums and HSA contributions can enjoy pre-tax savings. Approximately 25% in tax savings to the employee and 7.65% in FICA savings to the employer. The Super Combo is ideal for companies with higher income employees who can take advantage of multiple plans and want tax relief. It's perfect for older employees with their eyes on retirement. Funding an HSA with pre-tax dollars and then drawing out funds for eligible expenses without paying taxes is an excellent retirement strategy, better than an IRA. It's perfect for employees who want to save all their expenses for future reimbursement. I've had an HSA for more than 10 years. I've tried to contribute the maximum to my account each year and even the extra $1,000 allowable after age 55. I haven't reimbursed myself for a single expense. I've got everything above $1,000 invested in mutual funds. If I ever needed money fast, I've got a record of all of my medical, dental, and vision expenses for the past 10 years and can draw out the same amount without paying taxes or penalties. It is money in the bank. Some considerations. The HRA portion of the Super Combo is a COBRA eligible benefit. If you are a COBRA eligible employer, you'll have to offer this benefit to ex-employees. While that may not seem attractive, it comes at a cost. Ex-employees are required to pay a COBRA premium to stay on your HRA plan. Employees need to be careful not to double dip. In our example, the employee is responsible for only $1,400, and if they meet the $3,000 limit, they cannot reimburse themselves from their HSA bank account the full $3,000 because the employer reimbursed them $1,600 of it. That would be double dipping. The participant should only seek $1,400 in reimbursement from their HSA account, as that is his financial responsibility towards the $3,000 deductible. HSAs are subject to PCORI fees. That stands for Patient-Centered Outcome Research Institute. Don't worry, they're not very expensive, and we do all the reporting and tax preparation for you. Another surprise, only C Corp owners are allowed to participate and be reimbursed by the Super Combo. If you are set up under any other business structure, you are considered a self-employed individual and not eligible for reimbursement because that's what the IRS says. Only C Corp owners can contribute to their HSA bank accounts through a payroll deduction on a pre-tax basis. Don't worry, if you're an owner of a company, you will still enjoy federal tax benefit on the money you contribute to your HSA account when you file your taxes. You're only missing out on the 7.65% FICA savings. If you'd like to read more about the considerations we just went over, you can go to our website at www.soundadmin.com and click on blog. You can search articles by alphabet soup category or type in the names of the article listed in this slide. If you would like to sign up for our newsletter and receive more timely information about alphabet soup topics each month, go to our main page on our website, scroll to the bottom of the page, and click subscribe. This last slide is a shameless plug to consider using Sound Benefit Administration for all your alphabet soup needs, including the Super Combo strategy. We're not a gigantic third-party administrator. We can design a unique strategy to suit your needs. We're located in Poulsbo, Washington, and use cutting-edge software to ensure the best experience for both employer and employee. Reach out to me directly by email, phone, or using our website to request more information. Thanks for watching this video.